conversations from single leg trades from days before.
All right, you can take over the screen, D.
Yep.
Share screen.
So I'm going to default right now to SPY in our example, and I'm going to go back to the single leg dashboard. And let me close this menu to expand the screen. Now, what this page does is isolate all the single leg options trades. Those are options trades that were not indicated as part of a spread or contingent trade. And we put those in a bucket, and then we analyze it from different perspectives. And you could see here that up top, we have different ways to analyze those trades. And we covered these in previous videos. We also covered all the way up to here. And I'm just going to do a quick recap here before we move down to the table. And what this shows over here is a distribution, first of all, of the option volume, the single leg option volume by expiration. So you could see here, these are the different expirations below. These are option expirations that are available to trade in SPY. And for each expiration, you'll see these volume bars that show the total volume of the calls in the yellow and the puts in the blue stacked up. And this allows you to visually see where there's a concentration of volume, which expiration. And if you hover over it, you could see the difference between the volume, the calls, and the puts. So this really just, what stands out is that the 0 DTs were the majority of the volume yesterday, June 26th expiration that expired yesterday. We're not open yet today. And then you could see that the volume drops off drastically as you move further out. Even the June 27th expiration that I'm hovering over, you could see is much less volume than those 0 DTs. And what this lets us visually see is how traders are utilizing options in SPY. And what they're mostly, we could see, is it's concentrated in those 0 DTs options that expire same day. And the next day drops off significantly, and then so on and so on. So that's how they were utilized yesterday. And we could see here in the table, it gives us some more summary statistics. 61% of the single leg trades were on those 0 DTs. Here's days to expiration. And then 14% were 14% of the volume were the options traded with 1 day left to expiration. In addition to the volume, what we want to see is, well, how were the options impacted by this volume? Did the option premium get pushed higher? Did it get pushed lower? Did it stay the same? That would be the next question. Now that we see where the volume is, how are the options impacted? And that's this line over here. You could see that that is the at-the-money implied volatility. And there are actually 2 lines there, but they're very close together. And they're almost merged. One line shows the previous days at-the-money implied vol. There's another line that shows the most recent at-the-money implied volatility. And then it allows you to compare if the implied volatility went up or down. So if there's a significant shift somewhere, we would see the 2 lines split off, kind of like you see here on the 0 DT, but that's already something that expired. So the implied volatility there with 0 DT is not meaningful. So Because they're very close together, we also put a dot on the most recent implied vol, and if it's up from the previous day, even slightly up, you'll see the dot green. If the dot is red, that means the implied volatility is slightly down from the previous day. And if it's a black dot, that means it was essentially unchanged. And we could see here that the term structure, okay, this is a horizontal skew. This is a term structure where the implied volatility change is different based on time, right? The further you go out, the more days to expiration, how does the implied volatility look? And here we see that the term structure visually is increasing or sloping up. So then the next question from here is, how did the options behave within the expiration? Now that we see where there's volume, we see how the term structure looks. Nothing significantly doesn't look like anything significantly changed because the lines are very close together. Although it looks like maybe right here in the intermediate term, the implied volatilities came in slightly, but they did increase out here in the longer term. But there's no real significant volume there either as we go out in time. So let's slide down now. And now we get this table with some more statistics to help us kind of understand what's going on within the expirations. So here are the different expirations listed here. You have the top 10. We could expand this. Let's expand it to all of them. And here we see that at the money IB, you can see for each expiration. So this is organized by the nearest term. So here are the days to expiration. You could see all the way at the end. And the table is sorted by the nearest expiration to the furthest expiration out. We see that the money implied volatility. And here we also see if there are any events that could be material to the option that will cover that expiration. So here in SPY, we see that we're expecting a dividend on September 20th, going ex dividend. So let's move on to how are these options look vertically, because there's also a vertical skew. And vertical skew is on each expiration, we have different strikes. You have the at-the-money strikes, and the at-the-money strikes are, the ones that are basically centered based on where the stock is, the closest to the spot. But then we have out-of-the-money strikes that are going above the strike, where the stock has to increase to reach. And then we have strikes below where the stock is currently, where the stock has to go down to reach those strikes. And the implied volatility on those strikes, they don't have to be the same. They could be much different than where the at-the-money implied vol is. But we have a lot of strikes, and we could graph it, or we could use some benchmarks just to get an idea what the skew may look like. And what we do here is we try to look for we take that at the money implied volatility. So you could see here, like over here, 10, let's say in June, we take the at the money IB, and it says it's 10.2. And then what we'll do is say, well, if we ran a 10.2 implied volatility through each strike, let's say we just did that exercise and we ran a straight skew. It said 10.2 volatility this strike, 10.2 this, 10.2, 10, all of them were 10.2. And then we compared it to the actual implied volatility in the market. We can measure the difference. Is it actually higher? Is it lower? Is it the same? And what we do is say, find me a 25 delta put and a 25 delta call. And then let's compare. So 25 delta put will be a downside put. It will be a put that is below the at the monies. 25 delta call will be a strike that's above the at the money. So here we could see, like for June 28th, it has 2 days to go, which is not that significant going out, but we could see that the upside call is 1.3% lower or discounted to that the money. The 25 delta put on the downside is trading 0.7% higher, which in relative terms, it's close to flat. It's not a very significant skew. 1% here or there is not a very significant skew. So I would say that skew is close to flat. And especially like look how as you go out in time, you could see how the skew is different. Here, July 31, which is 24 days away, you could see that the 25 delta call is 9.6% below the at the money vol, at the money implied vol. The 25 delta put is 7.8% higher than the at the money. So we could see how that going to the upside, implied volatility is sloping lower, going to the downside, it's sloping higher, right? So look over here, you can see 24 days to go. And if I click on it, July 31st, let's see if did I click on it? Yeah. July 31st, here it is, volume. We get this distribution. So here's the trading volume, centered around where the highest volume is, 535. Just like in the previous example, we have a distribution of the volume, but this time it's by the strike. So these are different strikes here. And SPY happens to have a lot of strikes, so this narrowed it down for us around at the monies, but we could expand it if we wanted to. But let's just concentrate where the volume is. So I'm going to keep it there. And what does this graph tell us? Well, at least in July 31, we see that there's a big volume over here on this strike, the 535 put, because the blue represents the put volume. The volume in that put was 5,696 contracts for a volume weighted average price of $3.41. So if we took all the trades in that put that were single leg, and we multiplied the volume versus the price that they traded at and took the volume weighted average price, it traded at $3.41. And here we can see there it looks like a bunch of calls between, I would say 546 and 565. It looks mostly calls, a little bit of puts to the downside. So in this scenario, let me expand it out further to this, just to see if there's anything. Okay, so there's nothing significant. So it cuts it off. These are cut off once we get to the, closer to the tails. Once you get closer to the tails, it cuts it off, because some of these options that trade in there could be very like a penny, 2 pennies. So it cuts. So this cuts it off at those tails. Now, also what we see here is what the implied volatility did on the day, from the previous day. Okay. And these lines look pretty close here. You could kind of see them separated. I don't know if you could see there at the end, but you could see a little bit of space in between there. And what this is showing us is that the implied volatility skew shift. And how did it shift? Did it flatten out? Did it steepen? Did it, did it curve more on the tails or the wings? And in this situation, we see that a lot of these red dots indicating that the implied volatility slightly shifted lower. There are a couple of green dots here that are coming out, further in the tails, a little bit of red there. But essentially, if we start here from the 526 strike and going all the way up to the 575 strike, that seems to have shifted lower. In other words, the implied volatility from around the at the money going higher has shifted lower. So based on the trading activity and where the implied volatility is, suggesting that there may have been, more selling pressure around those strikes. Okay, so you guys see how this is sloping down, right? From starting from the 530 strike going up, implied volatility is sloping down. And it looks like based on, yesterday's trading versus the previous day, that it continued to slope lower, right? That it came in even more than the previous day. And this gives us an idea how people were utilizing the options. We see where a lot of the puts that were trading were here, starting maybe at the 535 strike, going lower, and a lot of calls between the 546, 545 strike, going up, to 565. And you can see here, even at the 565 strike, the volume weighted average price of that call was $1.26. So still some decent premium. Let me come out here. This one at the 575 strike, volume weighted average price of 35 cents. So a little bit of premium. And obviously, like if we go out further, you probably, 600, you have 4 cents here, which would be the very far out tail. And now we have a pretty good idea, at least for this month, how about the trading activity, the distribution of options based on strike, the distribution of options based on calls versus puts, and how the option prices were impacted, and what the implied volatility skew looks like in this expiration. So let's just come back up here really quickly. Which one I was on? July 31st. July 31st, and here we could see that this skew, if we just looked at two metrics, is increasing as the strikes go down to the 25 delta, and it's decreasing as the strikes go up 25 delta. And then what about the change? So here, what we're looking at is the change in the at the money, the 25 delta put, and the 25 delta call from the previous day. So this is the change. Okay, this is a relative value based on the at the money. So this is what is the 25 delta put implied volatility relative to the at the money. What is the 25 delta call volatility relative to the at the money? But this looks at the change from the previous day. Okay, did the implied volatility move up or down? And this is comparing strike by strike. So it's finding the today's 25 delta put and saying, what was the implied volatility yesterday in this same strike versus today? It's finding the 25 delta call and saying, using that strike, what is the implied volatility today versus yesterday? And it's also doing that for that the money. So here we could see that if we went from the at the money strike to the 25 delta put, 25 delta call, the entire line shifted lower. At the money's shifted lower, 25 delta put shifted lower, 25 delta call shifted lower, and the 25 delta call on a relative basis declined by a bigger percentage than the 25 delta put and by bigger percentage than the at the money. So you can see, yes, it shifted lower more on the upside than on the downside. So that also gives us an indication how the option prices or premiums were impacted on yesterday's trading. Here's the total volume for single leg options. This is the percentage of the single leg trades that traded on July 31st expiration. So if we took all the single leg trades yesterday and said, well, what percentage of them traded on the July 31st expiration? You can see it's less than 1%, 0.6. And you can see the open interest on that expiration. This is the breakdown of the calls versus the puts. And this is the total days left to expiration, 24. We're right up at 9:30, Will, so I'm going to just stop there.
That was awesome, D. Thanks so much.
Yep.
As I mentioned earlier in the show, I will be away tomorrow, so we won't be having a morning show. Next morning show is Monday. So everyone have a great trading day today, tomorrow, and a great weekend. Thanks so much, D.
Thanks, everyone, for joining. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
Trade in peace.